Hello, I'm Jeremy Owens. Welcome to On Watch by MarketWatch. And welcome to Financial Literacy Month. April is a special month for MarketWatch, where we pride ourselves on giving readers and listeners the tools they need to make strong financial decisions. But we tend to avoid the term financial literacy and focus instead on financial fitness. What's the difference? Well, Editor-in-Chief Mark DeCambry wrote this week that learning about money is a lifelong journey, and the term financial literacy isn't especially useful. Mark says when it comes to understanding money, it's just as important to understand how you make decisions in that journey. And that's really what MarketWatch is trying to do with this podcast. We hope to help you understand what is happening in the economy and the markets, and how it could assist you. So in honor of this month, we plan to step back and look at some of the core concepts that you should have in your tool chest as you navigate tough financial decisions. Today, we'll talk about technical analysis of stocks and how you can use those concepts without having to obtain a PhD in finance. And then we'll talk about how to reduce your taxable income without being a millionaire. And as always, we'll take a quick look at the news stories we're watching right now and how they'll affect your wallet. First, let's talk about technical analysis of stocks. Technical analysis of stocks can be a tough habit to break into. Advanced concepts like a death cross and Fibonacci retracements can feel out of reach for investors without deep knowledge. But my friend Alyssa Corum of Investors Business Daily has helped convince me that you don't have to know everything about technical analysis to use it to your advantage. Dabbling with some of the concepts that she and her colleagues discuss regularly at IBD can help you determine the best entry points for specific stocks, as well as good times to buy index funds or ETFs. So I asked Alyssa to join me this week to talk about how the average investor could start to use technical analysis. Well, Alyssa, when I look at a stock, when I'm trying to analyze a stock, I really go straight to the fundamentals. I'm diving into the SEC docs. I'm looking at revenue and profit. I'm looking at corporate governance and the board. And, as an actual investor saver, I'm mostly buying index funds and a 401k, trying to get the entire market. So the question there is how do I incorporate any technical analysis? Kind of what should I know? What are the very basics here that I should be looking at?
Yeah, to me, I think fundamentals are definitely one pillar of the picture that you want to be looking at for a stock. And I think another very important element, as you said, is that technical analysis. So there are a couple of key elements. One is the trend. Because if you want to make money, you need stocks or the index or whatever ETF that you're in to go up, right? So if you are aware of what that trend is, you can improve your odds of success versus just flying blind. That's another thing that I like to think of with technical analysis. I don't go anywhere without my phone. I don't buy a stock without looking at the stock chart.
Yeah, and the one place I've really thought about it is entry points. And I'll give an example here. My buddy Dave, who's a regular listener. Hey, Dave. He got into investing back in 2018 by dropping some money on NVIDIA. And obviously that bet has done pretty well for him, and he wants to start diversifying a little bit this year. He told me that he wanted to invest in AMD and Google and kind of asked me what should I be looking for as an entry point? And I could kind of talk through when the earnings were coming and what to watch for and what to look for, for signs of a downtrend or an uptrend in the fundamentals. But I didn't have much to say in terms of how to figure out an entry point.
Yeah. So digging a little deeper into uptrend versus downtrend, you also want to be looking at the direction of moving averages. And that's not to scare anyone off, but there are a couple of moving averages that are very widely followed in the market. And actually, I kind of view those as training wheels. If you are looking at what's going to keep you in the market or be a reason to get out, it's looking at the direction of those moving averages. So the 50-day and the 200-day on the daily, and then those rough equivalents on the weekly chart are the 10-week and the 40-week. And honestly, that's really all you need to be looking at, whether it is on the index level or individual stock level. I mean, if you just look at a weekly chart of the NASDAQ from 2020 to now, you can see the direction of that 40-week moving average. And when we were above it, that was a good time to be in the market. And when we fell below it in late 2021, early 2022, that was the time to get out. So even just looking at directionally, where are we in relation to those moving averages, that could be a huge help with timing your buys.
You'll see these charts with the 50-day moving average, which is more of a smooth line, and then the daily moves of the stock that's a little more jagged. So we're looking to kind of see when the jagged lines are moving toward the smooth line. That's called retaking the 50-day moving average if it's below, right?
So when I'm looking to buy a stock, I definitely want to see a rising 50-day moving average above a rising 200-day moving average. And then the price, because if you think about charts, what is the price? It's a visual representation of supply and demand. So it's sort of giving you a sense of, okay, what are buyers and sellers doing? And I always go back to improving your odds. So if I want the odds in my favor, I want that stock to be rising, but I don't want it to have gone up so much that you get this almost gravity effect where you get mean reversion, it's going to come back down. So that's why those moving averages are key. If you see a stock close to a moving average, so retaking a moving average, which was something that you mentioned. So if it's retaking the 50-day line or pulling back to that level and bouncing, that could be a good entry point.
In general, this is basically support and resistance, right, Alyssa? I know those are two terms you use a lot, and very simply, it's when a stock is being supported, it's usually heading higher. When it's hitting resistance, it usually signals it's going to head lower.
Yeah, exactly. Another way to think about it is a floor of support and a ceiling of resistance. So where is the stock going to bump its head, or where is it going to find a floor? And so you can look at those levels to see, okay, if you're at a floor, does it hold? That's a good thing. But if you're at a floor and it falls beneath that, that's an expectation breaker. And so same thing with ceilings. That's why we look at sort of these digestions or pauses. We call them bases or chart patterns to buy, because if it breaks above a ceiling, then that's a positive expectation breaker and could signal even higher prices.
What other terminology is in common use, and how can we kind of define that for people?
Yeah, so chart pattern, base, buy point, those kind of all go together. So if you think about a stock making a run like a mountain climber, well, you're going to need to pause to catch your breath every once in a while, right? So look for those pauses. Those are chart patterns or price consolidations where a move is being digested before you make that next leg up. So when you see a stock clear a prior high, or it can be a bounce off of the 50-day line, there's various buy points. And then I think also going into risk management, you want to have a stop loss, because there can be times where your stock goes down 10, 20, 50, 80%, depending on, what the broad market's doing or other various factors. So I think having a stop loss in place, so a point at which you are selling, knowing that going in wherever you see that buy point is, a big part of the equation there.
Right. Just like entry point, the exit point is something you want to have on your radar, right? Even if you do think that you're going to be in this stock for the long haul, there can be points where at the very least, you should go ahead and pull some profit out and at least cover your nut, right?
Yeah, exactly. There's offensive sell rules, so selling into strength, defensive sell rules, because no one has a batting average of 1,000, right? Not every stock that you buy is going to go up or going to have that immediate payoff. So if you have a stop loss in place, that's really going to help you protect your capital, because if you take a 50% loss, the math gets pretty cruel, right? The bigger loss you take, the bigger gain you need just to break even. So for that 50% loss example, you need a 100% gain just to get back to break even. And I don't know about you. We're in a strong bull market right now, but oftentimes 100% gain is pretty hard to come by, at least in a relatively short time frame. So you just got to cut your losses. Even if that stock ultimately moves higher, you're just playing the odds and protecting your portfolio. You can always try and get back in if another setup happens.
For people who don't really want to be active investors, more savers, but do want to think about technical analysis, see how it can, come into their world and help them, even if they're not going to be super active buying and selling, what do you suggest they do to kind of incorporate but not go all the way on this, Alyssa?
Yeah, I think that there's one easy tip that's actionable that I could leave the audience with, and that is to look at the 200-day line on the daily chart, which is also the 40-week line on the weekly chart on the index level. So say you're in index ETFs, that's great. If you just layer in whether we're above a rising 40-week line or below a declining 40-week line as your signal to be in or out, I think over time that's going to have a huge difference in your performance. If you sidestep, like the bear market of 2022, using that signal alone would really, really help you with your performance. And if you really want to start actively trading individual stocks, I think a big thing to think about for risk management is, in addition to having a stop loss, is thinking about your position size. So you don't want all of your cash in one stock. That can be pretty risky, right? So think about a percentage of your portfolio that you're willing to risk. So if you want to allocate maybe 5% of your portfolio to a single trade, well, if that trade goes to zero, then ultimately only 5% of your portfolio is damaged. So think about a ratio that works for you. And we often do the math with position size and stop loss to find that percent portfolio risk or dollar risk. It really isn't too hard of a math equation, but at the end of the day, I would say about 5% of your portfolio to allocate to a trade, and then use a good stop loss there. That way you can keep those risk management principles at the heart of your portfolio, and you're not going to get too much damage, and let your winners run and cut your losers short. That's the key to proper portfolio management using technical analysis.
And for those interested in learning more, Alyssa hosts IBD Live, a streaming show every morning starting about 10 minutes before the opening bell. And there's lots more out there that she's doing. Alyssa, any final advice for those of us who are interested in diving into technical analysis?
It just takes some experience. Don't give up. You got to stick with it. And I promise you, it's worth it. It's very rewarding when you can have a strong market and able to pick those true leaders and ride the trends that, a couple years like that, and that can have a very big difference on your portfolio over the long run.
Yeah, a little note for Dave, man. Not everything is going to be NVIDIA. Good luck.
Yeah.
And good luck to you, Alyssa. Thanks so much.
Thanks so much for having me.
We're going to take a quick break. Coming up, tax tips. Stay with us. Welcome back to On Watch by MarketWatch. Before the break, we talked with Alyssa Corum from IBD about how to potentially make more money from your stock investments. Now we welcome Andrew Keshner to discuss how to keep more of your money instead of sending it to the government. Andrew is MarketWatch's tax guy, and as we approach the deadline for getting your taxes in this year, he dropped by to talk to us about how to get ready for next year's taxes. Specifically, he wanted to let everyone know how to reduce their taxable income, even if they're not a millionaire. A lot of millionaires, Andrew, have their own ways of reducing their taxable income to reduce their tax bill. But for those of us who aren't fortunate enough to have a team of people figuring out how to do this for us, you're here to kind of help us get through it. And the biggest way to do this is through deductions. Can you just walk through the difference between a deduction and a credit before we dive into how to use deductions to reduce your taxable income?
Yeah. So this is like one of the basic things of taxes is the differences between a deduction and a credit. A tax deduction, that will reduce your taxable income. And then a tax credit actually is the better of the two. That's going to shrink your liability, your tax bill, dollar for dollar. So it's kind of, I like to think of the tax code like this crazy Rube Goldberg contraption where you start with money at one side that you make, and then there's all these ringers and things that chop up and add up and don't. And then at the very end, it spits out as like, ding, here's a refund because you overpaid, or ding, here's a tax bill because you didn't pay enough. So deductions are one part of the process, and then there's tax credits.
And when people have a tax credit, they likely know they have a tax credit. But deductions are a little bit differently. You do have to plan for those. And so for what we're talking about right now would be planning for next year's taxes, right? If you want to try to bring down your taxable income, it's probably a little late considering taxes are due in about a week and a half now. But for next year, to think about how to reduce your taxable income, most people will take the standard deduction, right? What is it? About 90% of people take the standard deduction?
Yeah, about 90% according to IRS statistics. Part of the reason why is way back in 2017, during the Trump tax cuts, what they did is they really boosted the standard deduction. It made it a lot more enticing than itemizing your deduction. So for 2024, for an individual, it's $14,600. And for a married couple that's filing jointly, it's $29,200.
So to itemize your deductions, you would have to clear that level. Basically, you would have enough to deduct that goes beyond that standard deduction level. And there are reasons why people would have those deductions. If they gave a lot to charity, or maybe if they bought a house, what are the reasons that maybe people who are listening would think, well, maybe this is the year I go ahead and itemize my deductions because they will clear that limit?
So the list includes charitable contributions, your mortgage interest payment, your state and local taxes, but only up to $10,000, your medical expenses, unreimbursed personal property losses from a federally declared disaster.
If you know some of those deductions apply to you, now is the time to start looking for more potential deductions for this tax year. And then what we just said, there are more you can find. And if you're in that situation where this is the year that you could itemize a lot of deductions, go past 15 grand or so for a single person and 30 grand or so for a married couple, you should know that now and start planning for it to make sure that you have the documentation to effectively itemize these deductions.
You know, it's really important to do as much record keeping as you can in the heat of the moment. Because if you save it to the very end, you're going to make a rush decision that overlooks or misstates. Or like, I don't know how much I spent on my medical bills this past year, so let's just do the other one. So if you just put in a little bit of work, a little bit of planning through the year, it's going to be easier at tax time to make that calculation of where do I get the better bang for my buck.
Yeah, and another way to do this beyond deductions is to put more into your retirement savings, especially 401k, right? Since the money you put into those kind of accounts does not get counted as taxable income when you put it into a 401k.
Right. So when you're putting money in a 401k, that is technically not a deduction per se, but what that is doing is it's removing the compensation that otherwise would be taxable. And it's removing it and putting it in a retirement account, and then fast forward when you need it years later, that's when taxes will apply. But for now, it's just putting it on the sidelines and shrinking your bill.
And if you see yourself at the bottom of a tax bracket right now, is it possible to put a little bit more in your 401k and drop down a bracket?
You know, bracket management, wherever, up the ladder, down the ladder, I mean, that is something that everyone can do. I mean, the reality is you could certainly use it to try and keep your income at certain levels.
And that's something to think about as you're doing your taxes this year. So if you see yourself on the bottom of a bracket and realize that you're probably not getting a big raise or anything in the year ahead, that's what you want to think about right now is how can I work this year to make sure I'm in that lower bracket and pay less tax?
Yeah. You could definitely think about that, but you also have to play that into how much can you afford to put into a 401k versus your household expenses. I would love to sock away so much more in my 401k, but it's this juggling game. But it is definitely a strategy to keep under that next bracket to avoid that next rate.
And with deductions, there are broad deductions that we kind of talked about, and then there are very specific ones based on what your profession might be, right? And that's something that you can also kind of look at when you're making these decisions.
Right. For example, student loan borrowers, there's a deduction for the interest that you've paid. If you are a teacher, there is a deduction. Many teachers will say it's probably not nearly enough, but you can deduct up to $300 in your unreimbursed expenses that you pay for school. There's deductions for if you're in the military and you're moving. There's deductions for performing artists, for people who pay alimony, for people who yank their money a little bit early from a bank CD. So there are these very fine-tooth deductions out there. You got to know where they are. I mean, the likelihood is maybe your software or your tax pro will say, hey, be aware of this. But yeah, there's definitely specifics out there.
And these are the things you can look at right now. When you're doing your taxes this year, you can look at maybe where you could have deducted and compare that to the standard deduction. And if it's anywhere close, you might want to think about, well, this year, maybe I'll look to give a bit to charity and get over that level and increase my deductions beyond the standard.
Yeah, I've heard it said from certain financial planners about charitable contributions, the idea of bundling it. So you're kind of like grouping it all in one year to make your charitable contribution to the cause you care about, and then also get that tax break and make it worth your while to get that itemized deduction. Because if you spread it out over, 2 years, it's not as efficient for you from a tax perspective. So yeah, there's always strategy.
What else should people be thinking about in terms of planning for next year's taxes or future taxes and looking to reduce that taxable income?
So you mentioned retirement, and it feels like a great way to do it. How much can I afford to save? If you have an IRA, you can actually make contributions to that IRA through April 15th. There can be a deduction on that. It gets complicated as far as how much money you make and your filing status and if you have access to a job, but there's ways to do that.
And for those who own their own small business, there is definitely a different classification there where you do have a lot more opportunity to deduct.
Right. There's an array of ways that you can do it. Your business expenses are certainly deductible. There is a part of the tax code called the qualified business income, and that is a 20% deduction. There's many rules surrounding that, but that is part of it as well. There is a deduction on your self-employment taxes. Kind of in the heat of the moment, you pay the employer and the employee side of the employment taxes. And then in tax time, you square it up and you get your deduction for, just to pay one side of it. So there's definitely this whole different world of deductions if you're in business.
So yeah, the important thing here is to realize what specifically about you could lead to more itemized deductions, whether it's because of your profession or a big purchase you've made, like a home, or the fact that you own a small business. Those are the things you really want to look at and figure out if it can lead to lower taxable income through deductions, and then if it surpasses that standard deduction. And in that case, if it does, you want to start saving everything you can right now in terms of records to be able to deduct those expenses next year.
Yeah, all the records are is really just your belt and suspenders in case you get a letter from the IRS saying we have some questions. So be ready in case those questions happen.
Before we go, it's time for What We're Watching, a look at the news you need to know for the rest of the week and beyond. Disney chief executive Robert Iger won a long-running battle with activist investors Wednesday. An assault led by Nelson Peltz's Trian Fund Management hedge fund failed to win over Disney shareholders, who voted to retain the current board. The vote was viewed as a referendum on Iger, who returned to the CEO seat at Disney in late 2022 after an abbreviated retirement. Now, Iger will have to prove he can make streaming more profitable, which includes plans to crack down on password sharing and Disney streaming services. Tomorrow morning, we'll find out how many jobs were created in the US in March. Economists expect the number of new jobs to hit 200,000, which would be the lowest number since November, but still reflects strength. If the number comes in lower, however, be on the lookout for a reaction from the stock market and potentially the Federal Reserve. Next week is the last week before tax day on April 15th. So if you haven't done your taxes yet, it's time to bust out the W-2s. We'll bring Andrew Keshner back to discuss what we're expecting to see from this year's tax season next week. I'll talk to you then. And that's it for this episode. Thanks to Alyssa Coram from IBD and our tax guy, Andrew Keshner. To keep following the latest on Financial Literacy Month, head to MarketWatch.com. You can subscribe to the show wherever you get your podcasts, and please do. If you like what you heard, please leave us a rating or review. It really helps others discover the show. And let us know what you want to hear from us. You can reach us at onwatch@marketwatch.com, where we'd love to hear your ideas for Financial Literacy Month segments. The show is hosted by me, Jeremy Owens, and produced by Meta Lutzhoft and Jackson Cantrell. Isaac Gaines mixed this episode. Melissa Haggerty is the executive producer. We'll be back next week with a new episode, and until then, we'll be watching.